Chapter 12 will deal with real estate taxes. One of the important issues that we need to understand, or concepts, is something called ad valorem. That means according to value. Your property, your local property appraiser, is going to assess your property and charge you ad valorem taxes. That is, taxes based on what it's worth. It should be determined through what we call just value. In other words, what is everybody else paying? What's everybody else's property in your neighborhood worth? When you get your tax bill, when you get your initial bill that comes out, it's not going to be a real bill. It's simply going to be an estimate of your tax bill. You will have a period of time to protest. You'll have 25 days to say, hey, I don't like this bill. I'd like to protest it. Probably you can either go to the property appraiser's office or you can go to the Value Adjustment Board, either one. But you've got 25 days to file your protest. Now, let's talk about the various types of properties and the way that they make up our community. We're going to talk about properties that are immune and properties that are exempt. To begin with, let's talk about properties that are immune. Any and all government properties are immune. And what that means simply is that these properties don't even show up on the court records. They have no value. They're just there. They don't contribute toward our tax bill or our tax basis. Every community has certain properties that are immune. Certain areas have more properties than others. Probably the Panhandle, with a lot of military bases, have a lot more than some of your other areas might. Properties that are exempt, however, are not government properties. Properties that are exempt are typically nonprofits and churches. A good example of a nonprofit, at least in the state of Florida, that doesn't pay real property taxes is Blue Cross Blue Shield. They are totally exempt, so whatever their assessed value is, they get to deduct it all. There's no taxes for Blue Cross Blue Shield. As far as the homestead, in the state of Florida, and by the way, not all states have homestead. In the state of Florida, we have a special homestead exemption, and this is the way it works. The first $25,000 of assessed value is fully exempt from taxes, from all taxes. And by the way, there are three basic districts. There are others, but there are three basic districts: the school district, the city, and the county. Those are the three districts. And so the first $25,000 of value are exempt from all taxes. If your property is assessed for $50,000 or more, then you are eligible for an additional $25,000 of exemptions, except for the school district. And that was part of the legislation, that you'll get the other exemptions, but in the school district, that second $25,000, you still have to pay taxes there. There are some other exemptions that we have. Unmarried widows or widowers that are legally, and also individuals that are legally blind, there's an additional $500 of exemptions. There's military-related disabilities. We also have Greenbelt. And Greenbelt laws basically cover any agricultural property. And these are all in a zoning pattern. In other words, each of the counties have zoned out and said these areas we're going to identify as agricultural properties. These Greenbelt areas get a lower assessed value. The millage does not go down, but their assessed value certainly goes down. And one of the main reasons is that in these Greenbelt areas, agricultural properties, a lot of your zoning is very low density. Sometimes as little as one house in 20 acres, which means it really doesn't have a lot of value. As far as calculating your property taxes are concerned, our property taxes are calculated in mills. A mill is 1/1000th. 2 mills is calculated with .002. 20 mills, .020. And basically what we do is we take our assessed value minus any exemptions, gives you your taxable value. Your tax base, or your taxes, will be based on that taxable value and not necessarily the assessed value. Now, if you don't have any exemptions, obviously your assessed value will be your taxable value. One of the big things that we need to understand also, the non-payment of real property taxes. If a person fails to pay their real estate taxes in a timely manner, to begin with, your bill comes out November 1st of each year, and you have till April 1st of the next year to pay your real property taxes. If you fail to do so, you're delinquent. And what's going to happen is there's going to be an auction to sell a tax certificate. Basically what's happening is that somebody else is going to come in and pay your tax bill for you. Now, the way this works is that people are going to bid on it. The bidding starts at an 18% annual interest rate and works down to the lowest bidder. And whoever wins that bid is going to pay your taxes for you, and at some point within a 2-year time frame, or more maybe, you need to repay them plus interest. Now, there's nothing they can do to your property for 2 years. At the end of the second year, they can apply for a tax deed. And what that tax deed is basically going to do is send that property into foreclosure. It'll be sold to the highest bidder to pay the property taxes plus interest. And I also want to caution you that real property taxes are considered to be a superior lien, which means that they're going to be above and take precedence over any other lien below that, which could include a mortgage lien. So a real estate tax lien is probably going to clear out everything below it. One of the things that we need to be cautious of is that if you buy a tax certificate, you cannot hold it more than 7 years. If you hold it more than 7 years, it does expire. As far as federal income taxes are concerned, there are a number of issues we deal with. Mainly the sale of real property has something that we call capital gains taxes. Currently, the long-term capital gains tax treatment that we use in this country is 20% of whatever that gain was. Now, long-term means that you have to hold the property for more than 1 year. A year and a day qualifies it. So what you're doing is you're paying taxes on whatever that gain is. An easy way to calculate gain, you take your purchase price, you add in whatever closing costs that you have. Later, when you sell it, you take the sales price minus your closing costs. Closing costs are a non-taxable issue. Also, let me caution you about depreciation or cost recovery. Every year that a person has cost recovery that they deduct from their taxable income, and by the way, that's a requirement. You don't have a choice in the matter. That lowers the amount of their tax bill at that particular time, but when you sell it, you have to recapture all of your depreciation or cost recovery, and you'll be paying that at a tax rate of 25%. So just because you get a break while you own it, it's one of those smoke and mirror things that comes back to get you when you sell it. Also, we have a pretty good deal going right now for primary residence. And that primary residence, the way that it works, if you own a home, it's your homestead, it's your primary residence, and you've lived in it for at least 24 months, out of the last 5 years, there are some exclusions of taxes. If you're married filing jointly, the first $500,000 of gain is excluded, is exempt. If you're married filing separately, or you're an individual filing by yourself, individually you get up to $250,000 of exemptions. So the homestead carries some pretty good exemptions out there. Also remember that as far as deductions are concerned, we get to deduct the mortgage interest and also property taxes. As far as investment real estate is concerned, I've already gone over with you the formulas for getting to our cash flows. Your potential gross income minus your vacancy and collection losses gives you effective gross income. Minus your operating expenses gives you net income. Minus your debt service or your mortgage payment gives you before tax cash flow. Then you subtract out your income taxes. That gives you after-tax cash flow. One of the questions that the state has always given is, how do you calculate taxable income? Well, that's a simple formula. It's real easy, so listen closely. We're going to take our net operating income. Remember, net operating income is minus all of our operating expenses, fixed, variable, and reserves. Reserves are money that we set aside to pay for things that break later. If you don't spend it, I promise you, it's going to be taxed. So we're going to take our net operating income, we're going to add reserves back in that we've not spent yet. The two big deductions that we get is the interest on our mortgage and what we call cost recovery or depreciation. Those are our two big deductions that we get. When we subtract those out, that gives us our taxable income. Then what we have to look at is say, what is our tax rate? What is our tax bracket that we're in right now? And then simply apply that tax bracket to that taxable income. And that gives us our income taxes that we apply every year. Two things that also defer taxes that I want to make sure that we understand: the installment sale and like-kind properties, both of those. Let me explain what the installment sale is. Anytime that the seller agrees to finance some of the sale of the property, in other words, owner financing, instead of taking all their money at one time, they say, you can pay me over time. Well, obviously, if you sold a home and you had or sold a property and you had a gain of, let's say, $300,000, that's going to put you in the upper income bracket. And that means that your income taxes will be high at that point. You pay taxes in the year that you collect the money. But what if you took that $300,000 over 10 years? That means you'll be collecting $30,000 a year rather than $300,000. That probably would bring your tax bracket down, and then you would only pay it as you went over the 10-year period. The other thing that we need to understand is like-kind exchanges. Some people call it a tax-deferred exchange or the 1031 exchange. What we're doing here is we are exchanging like-kind properties. And let me say this. When we talk about like-kind properties, we're talking about anything that we bought for income, business, or investment. And there are two exclusions. Your primary resident, it cannot be put in the mix. We cannot exchange it and defer taxes. It already has a pretty good benefit. The second thing is dealer inventory. And when I talk about dealer inventory, what I'm talking about is a builder who builds a subdivision for resale. Those properties that they build can't be brought in the mix either. So we've got those two items that are non-exchangeable. Everything else is exchangeable. The thing is that you can exchange like values, a shopping center for a warehouse for vacant land for an apartment. You can mix and match what you've bought for income, business, or investment, but it has to be of the same value. Anytime that it's not of the same value, then what you're going to have is probably cash brought in. Cash is considered boot. And so therefore, since it's an unequal exchange, whoever receives the boot gets the boot. In other words, whoever is receiving the cash is buying down, which means that they are going to be paying taxes on that boot that they receive. Remember that ad valorem taxes are real property taxes calculated in millage. Government properties are immune, which means that they don't show up on the tax rolls. Churches and nonprofits are exempt. They do show up on the tax rolls, but then are kicked out later. Our homestead is partially exempt. And remember I said that the first $25,000 of assessed value is exempt? And if that property is assessed for $50,000 or more, there's a second $25,000 exemption except for real property taxes. Greenbelt laws favor agricultural properties with lower assessed values. Non-payment of property taxes causes a tax certificate sale. Bidding starts at 18% and bids down. After 2 years, the holder of the tax certificate can request a tax deed through a foreclosure. In a primary residence, if you live in it for 24 months out of the last 5 years, there are special capital gains treatments. If you're married filing jointly, the first $500,000 of gain is exempt. Individuals up to $250,000 are exempt. Taxable income is your net operating income plus reserves minus the interest on your mortgage and minus depreciation or cost recovery. That will give you taxable income. Like-kind exchanges and installment sales typically defer taxes to a later date. And this is the end of this chapter's review.